All right, we need to talk about gold right now. As I'm recording this, gold is sitting around $4,966 an ounce, and it's up just under 4% in the last 24 hours. That's not a casual move. That's the kind of move that tells you something bigger is happening behind the curtain. And here's the part that should make you pay attention even if you don't own a single ounce of gold. China's central bank just extended its gold buying streak to 15 straight months. 15. That's not a trade. That's not a headline. That's a policy decision. That's a long-term message. And when the biggest players on Earth are steadily converting paper reserves into hard metal month after month, you have to ask yourself one question. What do they think is coming next? Because central banks don't buy gold for entertainment. They buy it for protection. Something bigger is happening beneath the surface. Here are the three factors that converge today. First, the official sector is acting like the dollar system is getting riskier. Let me give you the clean fact pattern. China's gold holdings rose again in January, up to about 74.19 million fine troy ounces. That sounds abstract, so let me translate the message instead of obsessing over the decimals. They didn't stop. They didn't take profits. They didn't pause to see what happens with prices. They just kept buying. And that matters because gold isn't like buying more of an index fund. Gold is a neutral reserve asset. It's not somebody else's liability. It doesn't require a counterparty to behave. When a central bank buys gold consistently, what they're really saying is, we want more reserves that cannot be frozen, cannot be diluted by printing, and cannot be defaulted on. And that tells you how they view the next few years, not just the next few weeks. Second, investors are rushing back into precious metals ETFs, even after violent swings. A lot of people assume gold demand only shows up when the price is already screaming higher. That's not true. The more interesting signal is whether investors are adding exposure during volatility, when headlines are scary and price action looks unstable. And that's what's happening. We just saw reporting that January brought strong inflows into gold and precious metals ETFs, billions of dollars, while gold miner ETFs also saw some of the biggest inflows in years. That's important for one simple reason. It shows the demand isn't only coming from one corner of the world. You've got official buying on one side. You've got investment inflows on the other. That's how you create a market where dips get bought, because you have different types of buyers with different reasons. And when you have that, the move can become self-reinforcing. Because every time gold drops, it becomes more attractive to the people who are accumulating for the long run. Third, the market is reacting to policy uncertainty like it's a live wire. Gold doesn't just trade on inflation, it trades on trust. Trust in central banks, trust in policy stability, trust in the idea that the rules won't change on you overnight. And lately, the precious metals market has been behaving like trust is wobbling. You've seen wild run behavior. You've seen sharp plunges. You've seen rebounds that look almost unreal. That's not what a calm, confident financial system looks like. That's what a system looks like when positioning is fragile, leverage is high, and a few policy headlines can trigger forced moves. Now put those three things together. Central banks accumulating, investors piling back into gold exposure, and a market environment that's reacting to uncertainty with violent repricing. That is not a normal backdrop. That's the backdrop you get right before people start rethinking what safe actually means. Now here's what Wall Street analysts aren't discussing enough. This kind of central bank buying isn't just bullish because it's demand. It's bullish because of what it implies. If you're China and you keep buying gold month after month, you're effectively saying, we want less exposure to a system where our reserves are someone else's promise. And once one major player does that consistently, it legitimizes the behavior for others. Because no central bank wants to be the last one holding the most paper in a world that's quietly shifting toward harder settlement. Now let's make this real with the current price. Gold at about $49.66 is not just a number, it's a stress signal. If gold was quietly drifting at 2% annual returns, nobody would care. If gold was dead money, nobody would be talking about it. If the world was perfectly stable, central banks wouldn't be building a 15-month streak. But we're not in that world. We're in a world where large institutions are paying up for insurance. And here's the psychological trap that gets regular people. They look at gold at $49.66 and they think, I missed it. But that's not how gold works in regime shifts. In regime shifts, gold doesn't politely stair-step higher like a growth stock. It moves in bursts. It corrects violently. It shakes out weak hands. Then it resets higher because the bid underneath it is structural, not emotional. Now I want to give you a historical parallel, because we've seen this exact pattern before. Go back to 2020. At the start of that year, most people thought the system was stable enough. Then uncertainty hit, liquidity vanished, and suddenly every investor on Earth wanted the same thing at the same time, safety that didn't depend on a counterparty. Gold didn't move in a straight line. It snapped, it dipped, it surged, it consolidated, it surged again. And the key wasn't that gold was predicting something mystical. The key was that gold was repricing trust. The world was waking up to the reality that the plumbing of the financial system can seize, that policy can change fast, and that safe assets can behave in unexpectedly unsafe ways. Now, I'm not saying today is a repeat of 2020. The pattern doesn't repeat exactly, but the sequence and the psychology remain remarkably similar. When uncertainty rises, the first thing people do is seek liquidity. Then they seek safety. Then they seek assets that survive policy shifts. That's when gold becomes less of a trade and more of a reserve. And that's exactly why central bank activity matters so much more than a random headline about retail coin demand. Because central banks are not chasing a weekend move. They're building a multi-year hedge against monetary and geopolitical risk. And you can see it in the persistence. 15 months is not a coincidence. It's not a buy the dip. It's a strategic posture. Now let's talk about what this means for your money directly. Let's say you've got a $200,000 portfolio. You don't have to be a gold bug for gold to matter to you. Because gold moving like this is telling you something about the environment your stocks and bonds are living inside. In a stable, low-stress environment, gold is usually boring. In a high-stress environment, gold becomes a pressure gauge. And when gold is ripping higher while policy narratives are shifting and volatility is rising, it's often a sign that the market is pricing in more turbulence ahead, whether that turbulence shows up as inflation surprises, rate volatility, geopolitical risk, or confidence shocks. Now, let me put it in simple, practical terms. If the next phase of this cycle includes more policy instability, more surprises, more sudden pivots, more emergency meetings, more unexpected statements, then the assets most dependent on low rates and high confidence can get hit fast. That could be high-duration tech. That could be over-leveraged real estate. That could be anyone who assumed rates only go down from here. But hard assets tend to hold their ground better in that kind of environment because they don't need a perfect story to function. They just need demand to stay persistent. And right now, demand looks persistent in two places that matter most: the official sector and the ETF investment channel. Here's the interesting part. Retail investors tend to react to price. Institutions tend to react to regime. Retail sees gold at $49.66 and says, too high. A central bank sees gold at $49.66 and says, this is what it costs to reduce counterparty risk. That's a completely different mindset, and it's why these trends can last longer than people expect. Now look, the question isn't whether gold can pull back. It absolutely can. It can drop $200 and still be in a powerful trend. The real question is, are you positioned for what comes next? Because if the story is shifting from everything is fine to we need reserves that can't be frozen or printed, then gold isn't just a commodity anymore. It's a referendum on trust. And right now, the vote is moving in one direction. Gold is at around 4,966. The next few weeks are going to determine whether this is the start of a new leg higher, or whether we're in a messy consolidation where volatility keeps shaking people out. But either way, the behavior of central banks is the signal you can't ignore. They're not posting on social media. They're not trying to go viral. They're not selling you fear. They're just quietly doing what institutions do before the crowd understands the cycle. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. All right, before you go, 3 quick things. 1. Drop a comment below. Tell me where you're watching from and give me your prediction. Where do you think gold is headed by the end of this month? 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype so the algorithm knows you're here for the original. 3. Next video drops tomorrow, and I'm covering the one indicator that tends to show up before the biggest gold moves. When it starts flashing, it's usually not subtle. You won't want to miss it. See you there.